This week coming, the profit reporting season really does start to kick in, and it will determine the direction of the stock market in the coming months. Among the biggest of those to report this week will be the Commonwealth Bank, AGL, Newcrest, our own owner, News Corporation, Suncorp, Boral and QBE. But what will really determine the future of these share prices and the market won't be the actual results, but their outlook statements, as Funds Management Hall of Famer Catherine Allfrey, principal of WaveStone Capital, explained to me this week.
I think it's, quite difficult for them. I think you've got to actually break, in terms of the Australian market, it up into the different groups. So the buckets, if we like, we've got the banking sector, and you noted the Commonwealth Bank's going to come out with their profits on Wednesday, which actually will be very strong, but it'll be more important about the outlook and the comments around margins and what's happening, because we're seeing mortgage arrears start to tick up. So it'll be really interesting in terms of what's happening as interest rates rise and the stress on households and businesses as a result of those interest rate rises, how they're managing that stress. And then, as going forward for the Commonwealth Bank, they're going to have to provision more for bad debts in 2024. So any outlook comments that Matt Coman makes with regards to the bad debt environment will be really instrumental and important for the share price.
One of the interesting things is looking out. This year it looks like it could be pretty solid, but in the out years it becomes a bit softer in terms of earnings per share growth. And that's the key thing that will drive share prices. Of course, not unless you start to factor in interest rate cuts that could change the dynamics of the economy and even some of those yield-based companies.
Yeah, I think we're a bit nervous this week. Obviously we're seeing the change with the Fitch downgrading the US government. We've also seen the moves by the BOJ in Japan around, yield curve control. And so the market is a little bit wary, and we've seen a bit of a sell-off this week on the expectation that interest rates could stay higher for longer. And there is obviously, a cost of capital now, which is good to see in stock markets as well. But that is actually very important going forward for company outlooks. How long does those interest rates stay high for, or reasonably high, not versus history, and when will there be enough, slowdown in the economies to see central banks around the world starting to cut rates?
And what's your own sense of that as you're factoring that into your portfolios, into the investments that you're choosing right now?
Yes, of course, we've got to always, it's a very, quite a volatile and choppy time. Just as you think we're getting over the inflation hurdle globally, there's always something else, to consider. And also we've got this sort of deflationary, sort of now pro-growth environment in China as well. So there's a lot to, get your mind across. But clearly now the market is pricing the fact that the US and the US earnings season that we've seen over the last few weeks has actually been pretty solid and better than expected in terms of earnings. And so there is an expectation that once we sort of get through this sort of slight market wobble over what's happened with Fitch and the US debt, that we will see, more positive outlook for, US companies' earnings. And so therefore that should drive, share markets higher. What does that mean for Australian stock market? Usually, Australia obviously follows the US. But the concern is that there will be a slowdown in 24, and going into this earnings season, what we're trying to establish as to whether or not there is a requirement for further downgrades in expectations for earnings for 2024 before we get too bullish about some more of a pro market or cyclical view on the market going further and rising from here.
Because that's what you've got to be careful of, isn't it? The suckers rally, that all of a sudden you start to see what looks like value emerging in a lot of these companies, but in actual fact there's further downgrades coming down the track that hit them even harder.
I mean, that's what we've seen in July, and then this week, of course, we've, the first couple of earnings reports haven't been as good as we'd expect, and I'll call out probably something like a Credit Corp that went up 20% in July, and then they come out with a result and bang, that 20%'s evaporated. So it is a stock picker's market. You do have to be pretty careful out there. You do have to obviously back management teams. You do have to take a long-term view like we do, and you have to, obviously invest in quality. And there will be still, some positive results that should come out from Australian companies that I guess their earnings beat to their own drum, and they've got their own growth plans, and those companies should, continue to grow. And it's those management teams that can take advantage of these times that we're in now that, you really want to back over the next 5 years.
One interesting sector, I think, is the small resources. We know they're highly volatile, and this year they're going to get crunched, but for a whole lot of factors. And you can see that in particular with some of the lithium miners that have come out. But then when you look into the out years, some of the forecasts are astonishingly positive for these same companies.
Yeah, it's all driven, of course, by the commodity prices and what happens. And you've got to remember there's a huge, production ramp up in lithium, for example, as well as, copper over the next few years in some of the, mining companies. But what we have seen in the last 12 months, of course, is the coal prices collapsed. It was at a high of 388. It's, now today at about 130. So, these commodity prices, of course, feed into those EPS numbers. So they are, a bit choppy depending on what's the commodity price outlook for that particular commodity. But the ones that we favour are the ones that can take a benefit from the whole decarbonisation process the world is going through. So you do want to be exposed to the likes of lithium, copper, and some aluminium in your portfolio.
But this is your long-term thinking about trying to pick those stocks, but also trying to take advantage of them when they do get hit by the market because of seasonal conditional issues that will happen for 12 or 18 months as prices fall for whatever reason it might be.
Yeah, of course. There might be a hiccup at the mine. We see that it's a short-term issue caused by, some sort of water issue or something. Then we'll take advantage of the weakness in the share price and top up our holding. As long as we're comfortable with the management and comfortable with the strategy and there is some production growth, we also favour, in terms of resources, low cost at all times. We're not into speculation in our at WaveStone.
So another area that also seems to be in there is international industrial companies this year. What type of companies are they? Because over the next a couple of years, they continue to perform according to the forecast pretty strongly. What types of companies are they?
So they're the Australian, largely what I would call growth stocks. So they're in the healthcare, they're in the technology names. So to give you for some examples, you would put in, CSL, ResMed, you put in Fisher & Paykel Healthcare, you'd put in WiseTech, Xero, James Hardie, Aristocrat, those companies that, most of their earnings, Macquarie's another one, where the earnings come from offshore. So they've got, the benefit of those global sort of rollouts of their products or services offshore. So those companies, as you can see, in 2023 is going to deliver strong double-digit growth, and again in 24. So they're the sort of companies that we like to invest in.
Which are the really resilient ones. I'll tell you what, it's going to be interesting. We'll get you back through this earnings season, just have another chat and see how these companies are all faring. But in the meantime, it's always good to have you, Catherine, on the program, and many thanks for your time today.
Thanks, Ross. All the best.